you'll be delighted to hear is that there's very little by way of scheduled news over the festive holiday break. But as soon as we get back into the new year, there'll be no slacking. On the macro side, keep an eye open for two sets of data. First, the latest monthly industrial confidence surveys, these Purchasing Managers' Indices or PMIs. The UK manufacturing, construction and service industry figures are due on the 2nd, 3rd and 4th of January respectively. Remember, a score above 50 is usually indicative of future growth. A score below 50 can warn of a slowdown or even a recession ahead. As we can see from this chart, manufacturing is booming, services are doing well, and construction is trying to recover from a bit of a dip in the second half of 2017, at least according to these particular surveys. Second, watch out for the latest US monthly non-farm payroll, unemployment and wage growth numbers. They're all due on Friday the 5th of January. They could help to shape whether and how fast the US Federal Reserve moves towards the 3 interest rate hikes it's got planned for 2018. The market's currently discounting just 2 1/4 point hikes. Now, the November jobs reading was strong, 228,000 new jobs added, the third best figure for the year, and wage growth moved up a bit to 2.5%. But that's still pretty low given that unemployment in America is down at 4.1%, and really we're waiting to see whether tight labour turns into rapid wage growth. If so, the Fed could move more quickly than the markets think. But then we could have said that a year ago, and wage increases stayed low, the Fed was able to move slowly. This graphic shows you monthly non-farm payroll additions and wage growth in America in 2017. On the corporate front, it's all going to be about retail for the first 2 weeks of the year, as we get a deluge of Christmas trading statements, and the one that could cause the biggest fuss for me is next, on Wednesday the 3rd of January. The FTSE 100 firm started 2017 with a profit warning, so management will be hoping to avoid this fate in 2018. Since then, that alert, the company's largely stuck to its earnings guidance, paid out healthy and regular dividends and special dividends, but the shares have still struggled, weighed down by soggy consumer sentiment, sticky inflation owing to a weak pound, and fears of what the internet is doing to traditional retail models. November's third quarter update went down pretty badly as the shares took a hammering on the day, even though the company maintained the midpoint of its profit forecasts, stuck to its plan to pay a fourth special dividend for the year, and pressed ahead with its share buyback programme. But analysts were not reassured by Chief Executive Lord Simon Wolfson's references to volatile trading, unhelpful weather, and a forecast which implied that full price sales in the fourth quarter, Christmas time, would be slightly down on where they were a year ago. So, when it comes to the fourth quarter and full year update, analysts will be homing in on two things in particular: full price sales trends and the full year pre-tax profit figure. For the trend in full price sales, Next has guided to a range of minus 1.75% to plus 1.25%. After 9 months, the total was down by 0.3, when retail was down 7.7, but directory was up 9.4. For the full year pre-tax profit figure, the midpoint of Next's guidance is £717 million, down from £790 million a year ago. Also watch for any guidance for 2018, where the current broker consensus forecast is for another small drop to £702 million. This next graphic shows the last 8 years and forecast for the next 2. This loss of momentum probably helps to explain why the shares did badly last year. Once we're past those headlines, there's one more issue that investors will want to understand, and that's the dividend. Last year's regular full dividend was 158p a share, and the interim came in flat for this year at 53. The company's also paid 3 special dividends of 45p apiece and has targeted a fourth. Assuming an unchanged final dividend and that last special, Next will offer 3.38p a share in dividends to January 2018, a yield of about 8%. Analysts and investors will be interested to see what the policy will be for the year just about to begin, especially as the company's revived its share buyback programme as well. So thank you for watching, and I look forward to seeing you next time.